You get paid. The bills get handled. Maybe there is a little left over. And somewhere in the back of your mind, there is a thought that has been sitting there for months, maybe years. I should probably start investing. And then life keeps moving. The moment passes. You tell yourself you'll figure it out when you have more money, more time, more certainty. When the credit card is paid off, when the raise comes through, when things feel a little more stable. But here is what most people don't realize. That sentence, "I'll start when things feel more stable," is not a plan. It is a delay that has a price tag attached to it. And the price tag grows every single month. According to a 2025 Federal Reserve Bank of Philadelphia survey, the #1 reason Americans give for not investing is that they don't have enough money. More than half of non-investors say this. And on the surface, it makes sense. Investing feels like something you do after you've handled everything else, after the debt is gone, after the emergency fund is built, after you've gotten to a place where you feel financially comfortable enough to think about the future. But that belief, that you need to wait until you have more, may be the single most expensive financial mistake an ordinary person can make. Not because it is wrong to be cautious, because it ignores the one variable that matters more than how much you invest. When you start, I'm Unus. This is Wealth Tactics, where we break down the psychology and the mechanics behind the money decisions that shape your financial life. By the end of this video, you are going to understand exactly why starting matters more than the amount, what is actually stopping most people from beginning, and the exact steps to open your first investment today with whatever you currently have. Let me show you the math that changes this conversation. Imagine two people, same job, same income, same financial goals. The only difference between them is when they decide to start. Person A starts investing $100 a month at age 25 and continues until age 65. Person B decides to wait until 35, maybe because they wanted to pay off debt first, or because they felt they needed to understand investing better, or because life was complicated in their 20s. Person B also invests $100 a month until age 65. Both investments are growing at a 7% average annual return, roughly the historical long-term average for a broad U.S. stock market index fund. Though it is important to note that past performance does not guarantee future results, and market values can fall significantly over shorter periods. Person A, who started at 25, ends up with approximately $262,000 by age 65. Person B, who started at 35, ends up with approximately $122,000. Same monthly contribution, same investment, a $140,000 difference, created entirely by a 10-year head start. Now, here is what makes that number even more significant. Person A did not invest smarter. They did not pick better stocks, time the market perfectly, or stumble onto some strategy that Person B missed. They simply started 10 years earlier. Those 10 years produced a difference that no amount of extra effort, higher contributions, or better picks could fully recover. The reason is how compounding works. The money you invest today does not just grow. It grows on its growth. The $100 you invest at 25 does not just become $200 by the time you're 40. It becomes something substantially larger because each year, the gains from previous years are themselves generating new gains. The early contributions are the most powerful ones, not because they are larger, but because they have the most time. The contributions made at 25 had 40 years to compound. The contributions made at 35 had 30. That missing first decade is the most expensive thing most people never realize they are paying for. And unlike most financial mistakes, it cannot be undone later by working harder or contributing more. And the data on where most Americans actually stand makes this real. According to Vanguard's 2026 How America Saves report, covering 4.6 million 401k accounts, the median balance across all working Americans with access to a workplace retirement plan is $38,176. That is the midpoint. Half of all American workers with a retirement account have less than that. For people between 25 and 34, the median sits under $20,000. For those between 35 and 44, it is around $40,000. For people in their 50s, approaching the final stretch before retirement, the median is still well below what most financial frameworks consider a reasonable target. These are not people who have failed. These are people who did what most people do. They prioritized today's expenses while telling themselves that tomorrow would be the right time to begin. So why doesn't everyone simply start? This is the part that most financial content skips, because the answer is not a lack of information. It is something more uncomfortable than that. The Federal Reserve Bank of Philadelphia surveyed thousands of non-investors in early 2025 and asked them directly, "Why haven't you started investing?" The most common answer, by a significant margin, was not enough money. But here is the problem with that answer. It is almost never literally true in the way people think it is. Because you can open a Fidelity investment account today with $0. You can buy an index fund with no minimum balance requirement. You can invest $1 if that is what you have available. The actual financial barrier to entering the market in 2026 is lower than the cost of a streaming subscription. So if the barrier is not genuinely financial, what is it? It is psychological, and it is specific. Researchers describe it as a version of the planning fallacy, the deeply human belief that there will be a better, more appropriate, more financially stable moment to begin. Not right now, later, when the conditions are more favorable, when the market is calmer, when I understand it better, when I have a proper strategy in place. The problem is that this moment never arrives on its own. There will always be a reason to wait. The market is never obviously the right time to enter. That feeling only comes in retrospect, looking back. Life is never uncomplicated, and certainty in investing is never available in advance. What keeps most people from investing is not a shortage of money. It is the feeling that starting before you are fully prepared is reckless, that you might make a mistake, that you need to understand everything before you put anything at risk. That feeling is understandable. It is also, financially speaking, one of the most expensive feelings a person can act on, because every month that feeling wins. The compounding clock keeps ticking for everyone who started, and not for you. Here is the other thing the financial industry tends to overcomplicate. At the beginner level, the strategy with the strongest long-term evidence behind it is also the simplest one available. You buy a broad, low-cost index fund that tracks the entire US stock market or the S&P 500. You invest a consistent amount every month, regardless of what the market is doing that week or what the news is saying, and you leave it alone. That is genuinely the starting strategy. Not individual stock picks, not cryptocurrency, not options or sector ETFs or thematic investing. Those conversations come later, if at all. The starting point is a fund that gives you ownership in a small piece of hundreds or thousands of American companies simultaneously, charges you almost nothing to hold it, and has historically increased in value over long time horizons. Though markets can and do fall substantially over shorter periods, and all investing carries risk. In practical terms, this is what that looks like in 2026. At Fidelity, the FXAIX index fund tracks the S&P 500 with an expense ratio of 0.015% and requires no minimum investment. You can start with whatever dollar amount you choose. At Charles Schwab SWPPX offers a nearly identical product starting at $1. Vanguard's VTI, which tracks the total US stock market, can be purchased in fractional shares from $1 at multiple brokerages. The question is not which of these is objectively best. At those fee levels, the differences over a lifetime are minimal and should not be the reason you delay. The only question that actually matters is which one you open an account for today. Now let's cover the exact steps. Not the concept, the actions. Step 1. Before you invest a single dollar, build a small emergency fund. The standard guidance is 3 to 6 months of basic living expenses. But even 1 month is meaningfully better than nothing. This comes first because investing money you might need during a financial emergency creates a dangerous situation. A job loss, a medical bill, a car repair, where you are forced to sell investments, potentially at a loss, to cover immediate costs. Your emergency fund is the buffer that keeps your investments from being disrupted by ordinary life. Step 2. If your employer offers a 401k with any kind of matching contribution, begin there before anything else. An employer match is not an investment opportunity in the traditional sense. It is compensation that you have already earned, which is being held back until you contribute enough to claim it. If your employer matches 50 cents for every dollar you contribute, up to 6% of your salary, that is a guaranteed 50% immediate return before any market gain occurs. Most financial frameworks treat capturing the full employer match as the highest priority financial decision available to a working American. Step 3. Open a Roth IRA if you are eligible. A Roth IRA is funded with after-tax dollars, meaning you pay tax on the money before it goes in. And in return, everything it earns grows completely tax-free, and withdrawals in retirement are not taxed. For 2026, most working Americans under the income phase-out thresholds can contribute up to $7,500 per year. Fidelity, Schwab, and Vanguard all allow you to open a Roth IRA online in under 15 minutes with no minimum balance to get started. Step 4. Select a broad index fund and set up a recurring automatic contribution. This does not require weeks of research. Pick any low-cost total market or S&P 500 fund at the platform you chose. Decide on an amount you can consistently contribute each month. $50, $100, whatever is realistic for your current situation, and set it to process automatically. The amount matters less than the consistency. The habit is what you are building at this stage. The amount grows as your income and confidence grow. Step 5. Stop watching it daily. This is the step that most beginners get wrong, and it is the one that tends to determine long-term outcomes more than any fund selection. The investors who historically fare best over long periods are not the ones who monitor their portfolios constantly. They are the ones who automate contributions, check in perhaps quarterly, and resist the urge to react when the market drops. Markets do drop, sometimes significantly. Every time you look at your balance during a downturn, you are creating an emotional pressure point that has no productive outlet. The response to a market decline for a long-term investor in a diversified index fund is almost always to continue the automatic contributions and change nothing. Setting up the system so that this happens without requiring a decision every month is how most people actually manage to sustain it. One more thing worth saying honestly. The median American approaching retirement does not have what most financial planning frameworks consider adequate savings. That is not a moral judgment about the people in that position. It is the predictable outcome of a financial system that makes investing feel complicated, exclusive, and risky to people who were never given a financial education, while also asking them to manage real, immediate pressures on their income every month. Starting is not easy for everyone. Some people are in genuine financial situations where investing is not realistic right now, and acknowledging that honestly is more useful than pretending that motivation is the only variable. If that is your situation, the most useful part of this video is the compound interest math, because it tells you exactly what is at stake and exactly why each month you are able to start earlier carries real and specific value. But for most people who feel like they are not ready, the actual barrier is not money or knowledge. It is the belief that beginning before everything is in order is irresponsible. That belief, held long enough, becomes the most expensive financial decision they ever make. Not through any single dramatic mistake, but through the quiet compounding of months and years when the clock was running for everyone who did start. If there is a thought somewhere in your mind that you should probably start investing, but that now is not quite the right moment, this is the moment. Not because the market is perfect. It never is. Not because you know enough. You will always be able to learn more. But because the cost of waiting has a number attached to it, and that number gets larger every single month that passes. The hardest step is not picking the right fund. It is deciding that this is something worth beginning before the conditions feel ideal. You already cleared that step by watching this far. Open the account, pick the fund, set up the automatic contribution. Let time do what no amount of research or discipline later can fully replace. This is Wealth Tactics. I'm Eunice. I'll see you in the next one.